We do begin, though, with our talk of the tape, the road ahead for the biggest and most popular stock in this market, that, of course, Apple. It's bounced 19% off its recent low. The question is, can that momentum continue? Let's ask Erik Woodring. He is Morgan Stanley's Apple analyst, the executive director of the firm's equity research department. Rarely does TV, but as you can see, he is today, and we are glad to have you. Welcome.
Thank you, Scott.
You know, it's been a nice move, obviously, off of the recent low. What is your outlook ahead for the stock in, a new month that is on our doorstep as we sit, really, as I said, between the 52-week low and the 52-week high?
You know, it's an interesting period to be an Apple analyst here, Scott. Clearly, what we see in the market today is consumer challenges when it comes to electronic spending, right? We're coming off of 2 years of record growth. There is some digestion going on, but again, Apple is one of the companies has industry-leading loyalty rates, very low churn. You can gain confidence that people are going to come back and buy iPhones. So as I look out over the next 12 months, I actually see a fairly robust catalyst path, whether that's the launch of new AR/VR glasses this summer, whether it's the launch of the iPhone 15, where we think there is pent-up demand given some of the challenges that we've seen over the last, let's call it 6 months. The other part I'd say is Apple has guided to a decade-high gross margin. That cannot be lost upon investors. And you add this up, and with the last factor being services reaccelerating, and I actually think you're checking a number of different boxes that get me excited about the next 12 months as an Apple analyst.
So I love the fact that you brought up what's happening in the services area of the business, which obviously is so critical to moving forward. You use the word reaccelerating because you really have had sequential declines in that part of the business. You had an incremental tick higher in Q1 of this year versus Q4 of last. But there seem to be real questions, particularly around the App Store and what a slowdown in revenue there means to the overall services business. So how do you square that?
So the App Store is, call it 33% of services revenue today. It has slowed. I would categorize the App Store as kind of a COVID beneficiary. We were at home, we were downloading new apps, we needed to keep ourselves entertained while we were at home. We're now seeing the other side of that. We're digesting that spend. I don't think the app economy is broken. Of course, we all spend more time on our phone. We continue to download and use our phone more than we ever have before. That's a good long-term driver. But ultimately, right now, quarter to date, we see the App Store growing at about 0.5%, maybe 1%. So it's not necessarily robust, but you have to also consider over the last 6 months, Apple and specifically the services business has faced, call it anywhere from 5 to 7 points of FX headwinds. So I'd actually argue that on a constant currency basis, the services business is growing low double digits relative to what we think would be kind of a mid-teens constant currency growth rate over the next 3 years. So it's been challenging. The services business has slowed, but we don't necessarily think the underlying drivers of the services business are structurally challenged. And again, as you get further out into the year, FX does become a tailwind. Services maybe App Store maybe slightly reaccelerates, but then you have to consider the other 66% of services, which we think is either growing robustly at, call it mid-teens to high teens, or the relationship with Google, kind of the Google TAC digital advertising business, which we see rebounding in the back half of the year.
I mean, you have it as your number one hardware play at a time where we're talking about a slowdown in consumer electronics, generally speaking. Is Apple immune to that or not?
I'd say they're more immune. Of course, they're not fully immune. If you look at what Apple reported for the December quarter, for example, where the wearables business down 7% year over year, despite launching a new Apple Watch, a new Apple Watch Ultra, new AirPods. That shows that Apple is not fully immune. But you have to remember, there's 1.2 billion people in this world that own an iPhone. I would call that the technology product that largely controls their world. That, to me, is a staple. I'd argue the iPad and the Mac are a level below that. And so are they fully immune? No. Are they more immune than others? Yes. And just one data point I'd throw out there. In calendar 22, Apple revenue grew roughly 4% year over year. The rest of my consumer hardware coverage, the median revenue declined 6%. To me, that shows that Apple is more immune than the large majority of the consumer hardware universe.
What about speculation around hardware subscription service? And I want to make sure that I read this correctly in the note. Do you think that that can really unlock an additional $1 trillion in potential market cap for already what is the largest company by market cap?
Scott, I'm happy you asked me. That is what gets me excited as an Apple analyst today. Remember, if we think maybe 5 years back, Apple was viewed as a cyclical hardware company. I think what we've learned over the last 5 years is that having a services business that's $70 to $80 billion represents more than 30% of gross profit dollars, ultimately makes it more like a platform, not necessarily a cyclical hardware company.